More bull and bear battles ahead in February? This is Tom Aspray with the Viper Report Market Wrap video for the week ending February 7th. With only one full week of trading on the books for February, it already feels like a tiring month. Of course, many people look at how we did in January in terms of what that means for February as well as the rest of the year. Well, January was quite good. The S&P rose 2.8%. Small and mid-cap stocks were higher, and according to Lipper, the average U.S. diversified equity fund posted a 3.43% gain. However, looking at the price charts, it was not quite that easy. In the last video, towards the end of January, I warned that storm fronts were approaching and provided the technical evidence for that view. If you want to keep up with the current videos that we do, sign up at the Viper Report at YouTube, and you'll get first notification. There are quite a few of theirs, and also a deeper explanation of some of the techniques that we use. It's important to look at trends on several different time periods. Of course, the most important is the monthly. And this is the monthly chart of the NYSE Composite, a very broad measure of the stock market, and it was up 4.7% in January. Still looks like a very strong chart. You can see this is the COVID low. We broke out above that and had a nice run to the upside, pull back into this support, at the end of 22, and then it's been up and away. So, stark bands here are around 21,500. And you can see the 20-month EMA is at 18,073. Most importantly, the AD lines turned up in January. They're still positive, and they made a new high 3 months ago with prices. No signs of a bear market or a top. You can see there were some signs in the late 21, early 22, but then we subsequently broken out of that range, which still has long-term bullish implications despite all the craziness we've seen in some of the economic numbers and policy changes. The storm front last time was based on what I was seeing on the weekly charts. So here we have an Spider Trust weekly chart. You can see it's made higher highs so far in 2025. The problem is that the S&P 500 AD line has made lower highs, as indicated by this red arrow. That's a potential negative divergence. A drop below this low here will confirm that divergence and imply a much deeper correction than we're seeing right now. So SPY closed at 600 roughly. So if we were to decline back to the 20-week EMA, that'd be at 586.83. That'd be about a 2.3% decline from Friday's close. If we were to get down to 575, which was the low we had this fall, right in here, that would be a decline of 4.3%. And if we were going all the way down into the 560 areas, that'd be a 5.8%. So you take these. Why is this important? I think in part of technical analysis, you gauge, particularly with who knows what's going to happen in policy changes come Sunday night or Monday morning. I'm sure, we may see a Super Bowl tariff or something crazy like that. But until we get intermediate signals by the AD lines dropping below their moving averages, the initial target seems to be the most likely. All right, so if you're holding nice gains for most of this period, a 2.3% pullback shouldn't concern you, because the odds are that if that's all we get, and you sell now, you probably will be back to where you sold out in a short period of time. If we get a deeper, more negative signs, look at the daily, then we look at the 4.3, 5.8, then, if you have a 10% gain, you hate to give up 5.8% of that. So you can see the stocks only is weaker. No divergence. It's made lower highs, but remember that the NYSE composite has not made a new high, therefore no divergence. Similar here for the NYSE all. It's closer to its highs, and certainly, a week of say 5 to 1 positive advanced decline numbers would break this out to the upside. This is one of the pages I use to teach my students about how understanding the market and the market internals. You can see for the week on the NYSE, not very strong. 1,443 stocks up, 1,394 declines. The NASDAQ was slightly negative, more new highs than new lows on the NYSE, but more new lows than new highs on the NASDAQ composite. We'll look at some charts of those shortly. Looking at a daily chart of the SPY, you can see we had a reversal on Friday. I warned about that we would want to see a major drop for the week. We didn't see that, but you can see on this bar here, if you look in the expanded view, hang on for 1 second. You can see on Friday we had a high of 608.13. That was above Thursday's high of 606.45, but then we closed at 677, right on the 20-day EMA. 50-day EMA is at 597.69, and that 100-day is back to that support we were talking about from other methods, 587.48. Important in looking at support and resistance, you use a number of different methods of determining those. Of course, with the pivot right here, is at 596, 595.98. So a daily close below that would reinforce the sort of negative pattern we've been seeing recently, and why we're looking for stormy weather back in here. S&P AD line. Let's turn off these data points here. Okay. You can see pattern of lower high. So this is the major divergence. AD line high here, S&P new high here, no new high on a daily basis either, and it's turned down here. So, right now they closed barely positive in terms of the S&P with a downward momentum. Volume did pick up. Little things that we teach. All week. Volume was green, was positive, but on and low. And on Friday, it was heavier volume as we declined. So S&P was down 0.82, I think, or 0.92 on Friday. NYSE stocks only, most sensitive one. It acts weaker than the one below it, which is the all. So you can see it's just closing fractionally above its moving average. It won't take much on Monday for it to turn negative. Probably take a little heavier selling to drop the NYSE below its moving average. Looking at the weekly chart of the QQQs, it was up as I went over the week. So near-term resistance, wouldn't be hard to start a new uptrend. Longer-term resistance here, the yearly R1 is at 573. I think once this sort of consolidation is over, that's probably the next likely upside target. A yearly pivot at 484 or 43.89, excuse me. And if we close below that, then that would be a more negative intermediate term signal. But we're quite a ways above that. So you can see last week the QQQ, or the NASDAQ 180 line, did make a new high on both a weekly and a daily basis. So that's a positive sign. I would like to see some of the other AD lines confirm that view to feel totally comfortable. Going back in time, 2015, if you chart historians look at July of 2015, the NASDAQ 100 did make a AD line did make a spike high in July, but it wasn't confirmed by the other AD lines. And a month later, we had that 1,000-point down drop on, I think, August 24th. So the RS is holding nicely, turned up last week. So that means it's still leading the SP. We look at the daily chart. You can see the same sort of reversal on Friday. Opened at 530.14, had a high of 532, and change, a low of 522, and it closed 522.92. So the pivot for the Qs is at 518.60, like roughly 4 points above where we closed on Friday, and it's also testing the 20-day EMA. So support around here is good, 503 down to 500. That's the strong level of support. I would expect it to hold, since it did in early 25 when the selling was heavier, particularly given the fact that the AD line here, daily AD line, spiked above its resistance, made a new high. The RS daily is still in a downtrend, so we'd like to see that turn up early in the week. So if it moves above that last high last week, that'd be a good sign for those looking to get into the Qs, despite some of the mixed fundamental data. In a recent contribution to Forbes.com, we commented on the sharp increase in bullishness is evident in this chart here. So we have the QQQ, we have its AD line still clearly positive above its moving average, and this is the percentage of bullish in the survey from the American Association of Independent Investors. You can see we hit quite a nice low level here right as we were bottoming out in the early part of December. Quickly moved back up, towards the high, but did not make a new high. And you can see we dropped back down to 25 at that point. And then 1 week we were up, roughly 18%. That's not generally a healthy sign, and now we're drifting back lower. So wouldn't be surprised to see this drop below 30 this week ahead, and that's sort of the range. Below 30, below 25 would be even better. That would likely coincide with the end of a correction if we get confirming signals from the other technical studies. That's the most important. Other things I didn't like from last week's action, you can see we have the S&P 500, the support, once again, just around 59.30, and then more important support here at the lows from early in the year, just under 5,800. You can see this is a percentage, so when it's red, so like for example on Friday, 46% of the S&P stocks were lower. It's seen, even though we've been moving higher, the buying looks to be dissipating here. That's also seen, and this is the S&P 1500, and in the Qs even more dramatic. We peaked right back here, and even though we were making a new high in the AD line, we didn't make a new high in the percentage of QQ stocks advancing, and on Friday, 55% were lower. Before moving on to some of the other market internals, you can see this chart of the Russell does not look great. First thing is these three tails up here in the last 3 weeks, all in that 230 area, and then the lower close it was down slightly, but it held above its moving average. Close it was 226, and the 20 week is at 224.23, but still not a great pattern here. The sector reports will be going out later today, and you can see here there's not a lot of changes. Only XLE is above 50, XLB 66.7, XLI 58.3. So they all have come back quite a bit from where they were at the recent rally peak. XLY holding at 58. XLP, it looked like it was bottoming last week, but it dropped to 41.7. Better looking in healthcare. That still looks, if we see some more profit taking, I think late buyers moved into healthcare, and I'm hoping for a decline there to be a buyer. XLF continues to be the leading the market higher, 100% positive on XLF, the financials. XLK going the other direction, and sort of XLC right in between. So we'll be watching that reading the next couple of weeks. Not much happening here in XLU or XLRE. They're both below 50. From the sector watch list, you can see that 53.3% are positive. just barely above the 50 level. Energy has dropped back down. You can see we tried to move up below the short term, in green, failed to move above the longer term here, so that's a little bit in doubt. We had some orders in XPO, but we pulled them. So far, we're on the sidelines here. You can see those stars, MPC and PSX, have quite a bit of green here. Not a lot of new signals. Materials, 66.7. Freeport McMoran, gave a daily buy on Friday. That's a chart to look at. And conversely in industrials, Honeywell closed below its quarterly pivot and is negative across the board. So a mixed bag here. Probably due to the tariffs. Some of these major industrial stocks have a large amount of business overseas, therefore should probably be impacted more. If you want to find out, if you go on the financial data for any of these companies, they should have an area for percentage of revenues from the U.S. or from outside the U.S. So clearly, as the tariff insanity goes on, you probably want to focus on those that have less exposure overseas. You can see the industrials crack back below the moving average. Materials, was this a bottom or just a rebound in a downtrend? Tough call. Consumer discretionary has reversed, so that's not a great sign. Consumer sentiment, was weaker last time around, and so a little more positive is in the XLP. Mondelez and Clorox, some green here. So we'll be watching, GIS, and CL to see if they get some positive. Costco and Walmart here leading the way higher. And healthcare, 66.7. So you can see Lilly, J&J, Amgen, ABBV, all strong, as is Abbott. Pretty much all except the real short term. So we'll be looking to see if these 4-hour negative turn into daily. That'll be consistent with a deeper pullback in XLV. XLF pretty much strong across the board here, and not much in way of a pullback there. Technology, the opposite. Cisco, AVGO, and ACN are the few positives. Lots of red up here. CRM just gave a 3-day DTS on Friday, so that should be a laggard on next week. Communications also a mixed bag technically as well as the sentiment. So you can see that Google had earnings and got dropped pretty fast. We're still holding long positions from lower levels. We closed out our positions in Meta for Viper hot stocks, took a quick profit, and so there are some opportunities there. And let's see, utilities, not much happening. ED and SPG for the real estate holdings, the only bright spots. They flipped. Oftentimes when you see the quarterly pivot close above the quarterly pivot, bright green, and a weekly DTS, it can be significant. For those of you who are interested in sentiment analysis, I recently referred to an article I've written early in the prior to the sharp COVID decline about stock market sentiment using the AAI data, and some pretty interesting turns. This one is in 2016. That's what you really like to see, is that AD line flipped back to positive as the sentiment was very low. I'll be posting this on the Viper report on Monday, I believe. And if you're interested in sentiment analysis, that's a good place to go. I do think that probably the worst of the selling is going to be over in February, and probably by the latter part of February, early March, the market will look much more appealing and should be making new highs by the second quarter. So if you want to subscribe and get specific advice on stocks or ETFs, go to the Viper report and sign up. As always, share your comments with me, good or bad, at tom@viperreport.com. Hope you have a great week and a happy Valentine's Day.